Welcome and Happy New Year, everybody. I am so excited that everyone's joined us for our first ever Zoom webinar. Isn't this super cool? It's Jim Elios calling you on video from Zoom, live and direct from beautiful Westlake, Ohio. I am so sorry that we cannot be at Le Center. We have done that. Many of you have joined us for the past 15 to 16 years. I'm sorry to say that Le Center is closed now. Obviously, we know the reason why, but we'll find another location next year. So we'll start right now. Hopefully next year I'll get to see everybody in person. I'm really going to miss Le Center. I'm going to miss the chicken Alfredo and the great staff. But most of all, I'll miss seeing you and laughing at all my lame jokes. But tonight we're going to make do. So grab your favorite beverage, grab your favorite snack, because we've got a very action-packed and full agenda. I'm super, super excited. So I'm happy to welcome a lot of clients and friends on this call, on this webinar. We're really blown over at the fantastic response. I've got friends and clients from all over Northeast Ohio, including everywhere from Avon to Chardon, Medina to Rocky River, Youngstown, Florida, Indiana, Maine, New York, and everywhere in between. So I want to welcome you again from wherever you're calling from. I hope your family is safe and happy and having a terrific 2021 start. So let's begin. Hopefully everybody's got their technology working here. So here's a little bit of the agenda. Thanks again for joining us. It's a real big thrill. So I'm going to start here in just a couple minutes. I'm really pleased and honored to welcome Mary Levin Butler from the Greater Cleveland Food Bank. What a great organization. We've got to know them, and she's going to be speaking about the great things that they're doing down at the food bank. And then we're going to introduce Jay Jacobs, who's Senior Vice President of Research at Global X. I think he is calling in from Park City, Utah, or New York City, I'm not sure, but he is head of research at Global X. Many of you own Global X ETFs. He's got a real exciting and interesting talk about disruptive technologies, something I am very interested in, and how that relates to COVID and the economy. So really looking forward to that. And then I'm going to come on, and Ryan, and we're going to talk about the market. I've spent a lot of time researching last year, researching COVID and vaccine. We're going to talk a little bit about that. We're also going to share some of the poll results. We had a lot of great responses on the poll I sent. So I'm going to intermingle a lot of the poll results throughout my talk. So please stay tuned. I know it's 6 o'clock. I know it's a Thursday. People are really, really busy. So again, I'm really honored that you would tune in with us, but stay tuned. I've got a really interesting prediction for 2021, and I've been right lately. So please stay for that. And then questions and answers. So we're really kind of tight on the schedule, but we will be here after the presentation for questions and answers. I'm hoping to be done between 7:30 and 7:35. Please stay with us the whole time. If you cannot, please send your questions through the Q&A tab on the Zoom tab, or just send us an email. We'll get back to you. That's really my favorite part, is answering questions. It's a little bit different on Zoom. So without any further ado, of course, I want to thank my wonderful team. Without Jennifer, Ryan, and Tara, not a lot of this can happen. So I want to thank them for all their hard work and diligence. Last year was such a challenging year with COVID, with the social distancing, with the masks. Through all that year, that challenging year, we really had our best year ever. And most of all, I want to thank you, my clients, our clients. When you're successful, so are we. It's a wonderful relationship. Thank you for everything. So let me tell you a little bit about what we're doing tonight. In lieu of the fancy Le Center banquet, we're going to be able to, I'm really happy to announce that we're making a cash donation to the Cleveland Food Bank, and we are donating 20,000 meals. And that could not happen without all of your wonderful support and support of my office and my team. So thank you for that. And, interestingly, going along with the Greater Cleveland Food Bank, hopefully you can see this funny looking gentleman here on the screen. Everybody knows that that's Drew Carey. And just 2 weeks ago, he was on Wheel of Fortune, and he was a celebrity contestant, and he won. And so interestingly, he is donating all of his winnings on Wheel of Fortune to anything but here, the Greater Cleveland Food Bank. We thought that was interesting because we had the idea first, but it's, Drew Carey is a wonderful Cleveland guy, and we love him, and of course the Cleveland Food Bank too. So at this time, it's my honor and privilege to introduce Mary Levin Butler. She is the Vice President of External Affairs at the Greater Cleveland Food Bank. She is a proud Rocky River, Ohio resident. And she does a lot of the fundraising, volunteer relations, corporate relations, and all the special events like we're having tonight. But she told me something fascinating, and hopefully she'll share her quick story. In her previous career, she was a fancy corporate lawyer out in Silicon Valley, and her law firm worked in Silicon Valley. Her firm actually was able to work on Steve Jobs, the legendary Apple creator, something to do with Apple and Steve Jobs. I think her firm worked on his compensation plan, which would have been a lot of fun. Anyway, without further ado, I'd like to introduce Mary Levin Butler from the Greater Cleveland Food Bank.
Thank you, Jim, and thanks to the staff at Ilios. You guys have just been wonderful to work for. And Jim is going to cue up my presentation so that I don't have to worry about it. And technology is wonderful when it works, and it's going to work absolutely certainly tonight. Jim's going to cue up my presentation. Thanks so much. And we are really grateful to Ilios for this opportunity to speak with all of you and for their generosity. Living in Cleveland, you can't be in a better city, in a better community in terms of the generosity of the people in our area. So why don't we move right ahead, because I know Jim's got a really busy presentation tonight. And so we'll go right ahead. Our network, we work with over 1,000 partner programs and agencies in a 6-county service area. The Greater Cleveland Food Bank serves Cuyahoga County, Geauga County, Lake County, Ashtabula County. Then we dip south to Ashland and Richland County. So we work with these different agencies, and we provide all these different kinds of programs. We basically serve seniors, we serve families, we serve children. Anybody who needs our services can avail themselves with us and through these program partners. And the services really run from anything from pantries to backpack programs. Backpack programs are probably one of the things that most people love, is because it really provides kids with shelf-stable meals, 6 meals for the weekend, because many kids go home on Friday from school and they don't have any meals. So the backpack program is very, very popular with many supporters in the community. We also do summer feeding programs, after school programs for kids, hot meals, shelters, and we do a lot of work with seniors. And that is really very rewarding. It's been quite a year. So like I said, over 1,000 partner programs in our 6-county service area. Okay, Jim, if you want to go to the next slide, please. 2020 was quite a year. Our byline, or our motto for 2020 was get comfortable with the uncomfortable, because everything we did in 2020 got turned on its head. We used to do lots of congregate meals, send out meals, congregate meals, school meals, kids. All of that was stopped because basically we had to shut down. And also we used to do distributions at our food bank, and that had to stop as well. But in 2020, we served 404,000 individuals, the largest number in our 40-year history. Actually, the food bank has been around since 1979, so we're in our 41st year. And this represents about 25% of the 6 counties that I just mentioned of our service area. That's amazing. We distributed 56 million pounds of food, representing a 9 million increase from the year before. And what I love is 37 million pounds was nutritious perishable food. As you all know, if you go to the grocery store, probably the most expensive food you can buy is the perishable food. That is protein and fruits and vegetables. And we have increased our distribution of this kind of food because we know people need it. It's good for your health. And it's something that is, like I said, expensive at the grocery store. And then more than 1/3 of the clients we served in fiscal year 2020 were turning to the food bank for the very first time, the food bank and our partners. Now, this is amazing because that kind of is reflective of what happened with COVID, the job losses, the economic downturn. And it really, really hit lots of families in our 6-county area very, very hard. And 2020 is not a year I don't think any of us want to repeat again for these reasons. But Jim, if you go to the next one, our efforts really help serve 56,000 children, 93,000 seniors, and 53 individuals with health challenges. We work with many healthcare providers in our area to have, usually we provide food for their clients at markets and mobile pantries at their sites. And then oftentimes if an individual gets diagnosed with either something that's related to food that can help, for example, diabetes or high blood pressure, they will be connected to our food bank through the medical care provider so that we can provide them with access to healthy food to help with that medical condition. That is really pretty amazing. You know, we lost many of our partners. I shouldn't say lost. Many of our partners had to close during COVID-19 because they just couldn't handle the distribution and handle it safely. We had to change our whole process, and we've made considerable investments to our distributions, including our weekly non-contact drive-through distributions. If any of you have been by the Muni lot on a Thursday, and today is a Thursday, you saw literally thousands of cars lined up through the Muni lot, and we have served basically through non-contact distribution. They register with us, we get their information, we send them through the lot, and then food will be put into their trunk. Basically they keep their windows rolled up. We all wear masks, but it's amazing. I have had the opportunity to volunteer at this Muni lot distribution, and the Thursday before Thanksgiving, in 2.5 hours, we served over 5,000 households. And I'll tell you, it's kind of a gut punch when you walk into the Muni lot. We all know, because that's usually where we do our tailgating for the Browns games, but to see it lined up with cars with people who need food, it is really something. In addition to, in addition to the weekly non-contact, we've been doing home deliveries. We have never done home deliveries before this year. And we knew that many seniors called in and they were afraid to come out of the house. They couldn't come out of the house. So with the help of the National Guard has been with us from March. And they have helped us make distributions and done all kinds of wonderful things. But you can just see some of the statistics here for our response. And this is March 15th is basically when the shutdown happened through September 30th, which is our end of our fiscal year, but we're continuing afterwards. But these are just some of the stats during that period of time. And it's pretty amazing when you see in terms of households, new households, drive-through distributions, calls to our help center. Many times seniors call to our help center for help. They don't know where to get food, or we deliver it to them. They need some help filing paperwork for benefits for staff and things like that. We also distributed more backpacks than we ever distributed before, almost 145,000 during this period of time. You know, school was closed, and so many of those kids didn't have food because a lot of them get food at school, breakfast and lunch. So the backpacks really helped out. We distributed them through a variety of different ways. We had emergency food boxes that we distributed. And then we had a wonderful federal program called Farm to Families, and that was fresh produce and all kinds of wonderful food that we distributed at the Muni lot. Okay, next slide, Jim. I just want to show you some of the increasing and changing demand. Over the past 15 years, we've tripled our distribution of food from 16 million pounds to 56 million pounds. Same time period, our kitchen has just quintupled the number of meals prepared annually. And that's really exciting because that's hot food, nutritious food getting out. We help Meals on Wheels. We work with Western Reserve Area Agency on Aging with school programs. So we went from 33,000 meals in 2006 to 1.6 million meals in 2020. We also have been a critical hub for families needing assistance. You know, this is a time when unemployment's run out and when we can help them avail themselves of assistance. And and where to go and what to do that. So our help center, we take all these calls, and we have benefits outreach so that we really reach out into the community. And we have to continue to expand our distribution of healthy food, because that also helps people with respect to healthcare related issues. And if we can keep people healthy, then we can possibly help them also find jobs and keep them out of the emergency food lines. So we're really working on creating extra space to address our clients with the help they need. So how can you help? Because I know Jim said, Mary, talk about how you can help. And I have to honestly say, the generosity of Elios for 5,000 meals. Is that correct?
20,000 meals. 20,000 meals.
20,000 meals. Pardon me. My goodness. 20,000 meals. You know, $1 can help provide 4 meals. We have tremendous buying power. So, I mean, you know how many people Jim and his group are feeding tonight. Wonderful. I'm so excited to share it with staff tomorrow when I go back. You can volunteer. You can volunteer Thursdays at the Muni Lot. You can volunteer at the food bank. All you have to do is go on our website. There's opportunities. Just click Give Help, and you can volunteer for a variety of opportunities. Obviously, you can donate. Like I said, $1 helps provide 4 meals, and you can participate in Harvest for Hunger. This is where we work with 3 other food banks in Northeast Ohio. And you probably remember this at the grocery store. There's the checkout at the grocery store where you could pull out the tab and have the grocery clerk add $1, $5, or $10 to your bill, and that comes back to the food bank. And so that Harvest for Hunger will be starting in February, and we're very excited about that. But again, go to our website, because there's all kinds of information there. And it really, and if you might know or somebody who needs our help, by all means, direct them to that website, because we have a variety of resources. Now more than ever, our community is in need. And I cannot thank the people of Greater Cleveland more than you can imagine, because they have so stepped up to help us. So I think that's my time, Jim, because I know you got a busy program, and I am thrilled. And thank you again. And thank you to everybody who's listening tonight. We are so appreciative of your attention to this.
Mary, thank you so much. That was super informative. Thanks for all the great work you're doing down there. And it's our honor to help out. So thanks again for your time. And we look forward to seeing you here soon. Thank you so much.
Okay, thanks, Jim.
Bye-bye.
Thanks,
Thank
Sarah.
you.
Bye-bye.
All right. So moving right along, without further ado, I want to introduce Jay Jacobs, and I'm going to be turning it over to Mr. Jacobs. He is head of research and strategy at Global X. Global X has become a significant partner with us. They are a leading and innovative exchange traded fund company. Jay guides the planning and the development of the firm's strategic direction. He is on CNBC, Bloomberg, and Wall Street. He's a busy guy and a smart guy. And I wanted to mention this for sure. Since you can't follow Trump on Twitter, please follow Jay at JJacobs CFA. Okay, he's on Twitter. So without further ado, I'm going to introduce Jay Jacobs, head of research at Global X. So Jay, I'm going to turn it over to you.
Great. Thank you, Jim. And thank you to all the clients and partners of Elios Financial. It's really great to be able to present to all of you tonight. I'm going to share my screen here so we can get going. Just going to quickly confirm, Jim, if you can see my screen. I believe I think everyone on the call should be able to see it. Are we good?
Yes, we can see it. Thank you. I'm going to mute now. Thank you, Jay.
All right. Skipping right ahead, Jim provided a brief background about myself and what we'll talk about today, but a little bit more about my firm. I work for a firm called Global X ETFs. We are normally based out of Manhattan. We create exchange traded funds. We identify opportunities to invest in the market. We spend time doing research into development, creating those ETFs, and we try to provide efficient access to investments or investment strategies to clients like yourselves, anyone, anywhere around the world in our ETFs. And we work very closely with Jim to, kind of curate a list of our ETFs that we think are most appropriate for the way that he's using them in your portfolios. We, in particular, specialize in what we call thematic investing. We have the most ETFs and the most assets in our thematic ETFs with 24 different ETFs, but we also extend beyond that into income and international strategies as well. Today, we'll be focused on that thematic investing side of things. We'll talk about some of the structural changes that have accelerated during the COVID-19 pandemic, which themes we see really standing to benefit from the reopening economy as well, and then we'll wrap it up from there. So structural changes accelerating during the COVID-19 economy with this thematic lens. So first, I kind of want to talk about what is thematic investing and how it might be incorporated in a portfolio. First of all, the definition, thematic investing is the process of identifying powerful macro level trends and the companies that stand to benefit from the materialization of those trends. So this is inherently a forward-looking investment approach. We're not looking at what happened in the last 10 years. We're not looking at what happened in the last 20 years. We're looking forwards to what's going to happen over the next few decades and anticipate those changes and anticipate what parts of the economy that's going to have a profound positive impact on. These are growth-focused strategies. They tend to be unconstrained by geography and sector. So, we'll talk a little bit about cloud computing today. We don't care if a cloud computing company is in the US or if it's in Europe or Asia. We don't care if it's classified as a technology company or a communications company. We want to find the cloud computing technology companies around the world that are best positioned to benefit from the rise of the cloud computing theme. These tend to be a bit more targeted and therefore, they're a little bit of a diversifier in a portfolio. And also what makes this fun to talk about is that these are relatable concepts. I'm sure when we talk about value investing or low volatility or correlation, sometimes it doesn't really feel tangible. That feels like something that lives on a spreadsheet somewhere. But when we talk about thematic investing, you'll be seeing these changes in your everyday lives. If you haven't seen them already, you'll start to notice them more and more after this presentation, which I hope makes it very interesting. So as an ETF provider, we create thematic ETFs. As I mentioned, we have 24 thematic ETFs, but we evaluate over 70 themes every single year. And we have a very strict criteria for what we think what a disruptive theme is. Of those 70 or so that we look at, we basically run them through a 3-step process. Do we have conviction behind the theme that it's going to change the global economy? Looking at all the research around the state of a technology, the path to profitability, the total addressable market, all these things to really get an understanding of how powerful this theme might be. Number 2 is it investable? As an ETF, we need to invest in publicly traded companies, and we want to get really precise exposure to the companies that are best positioned to benefit. So investability is key to us. And then lastly, time horizon or time frame. We want these themes to play out over multiple decades. We're not looking at themes that might be over tomorrow. It puts too much emphasis on trading in and trading out. We think the best way to invest is long-term buy and hold investments. So when you look at conviction, investability, and time frame, that's how you get to roughly the 24 thematic ETFs that we have today. And I'll talk about a subset of them in this presentation that we think is uniquely suited for this environment. So from a macro perspective, how do we think about COVID-19 and kind of the economy that we're in and the different stages that we've been going through? We really see COVID-19 as a 4-stage economy. The first was the pre-COVID economy. This was when we knew that there was some virus over in China, but it wasn't really clear what was happening. Would it come to the US? What would it mean for the economy? What would it mean for ourselves personally? So there wasn't a lot of focus on it, frankly. The government wasn't doing anything extraordinary in terms of fiscal or monetary stimulus. We were going about our lives in the financial world. We were talking about how great it was that there was a US-China trade deal to get the markets back on track. But that quickly changed by March 2020. As we all remember, the stay-at-home economy flattened the curve, shelter in place. We saw the massive amounts of stimulus from the US Federal Reserve, almost $3 trillion pumped into the economy and dropping rates to zero. We saw the $2 trillion CARES Act and fiscal support to help further stimulate the economy in a very unique period. But now we're in the reopening economy. Actually, we've been in the reopening economy for 6 or 7 months now. It started in roughly June 2020. We started to go outside our houses, offices kind of reopened, schools kind of reopened, restaurants, everything kind of reopened. But there was new rules. There was new rules around mask wearing, around temperature checks, around social distancing. We're still trying to adjust to what this environment will be, where we're kind of allowed to go outside, but we're still trying to protect ourselves against this virus and the spread. We saw not a lot of change on the fiscal or monetary stimulus side. The Fed kept kept asset purchasing roughly steady. Rates were kept steady. We saw the extension, kind of an extension of the CARES Act, the Lost Wages Act, and finally we saw another fiscal stimulus package pass for $900 billion in December. So we're continuing to pop more money, but kind of at a slower rate into the economy as we try to figure out what's going on and exactly what we can and can't do. But the next stage, which we believe might happen around Q2 or Q3 of this year, is the new normal economy. And this new normal economy is not the same thing as the pre-COVID economy. We're not going back to where we were before. The world has changed, and it's changed in many profound ways that we think is having a structural long-term impact on our lives and on the world around us. Now, I don't need to remind everyone of what happened in the stay-at-home economy. That experience was, kind of burned in our brains. And from a macro perspective, there's obviously a lot of stimulus going on. But some of those structural changes that happened during the stay-at-home economy that we think are really going to carry through forward beyond this pandemic have really had a really profound impact, not just on the world, but on portfolios as well. What you see in front of you on this slide is what we call the adoption curve. It was created by a professor in New Mexico, Everett Rogers. He was actually not a technology professor or anything related to technology. He was a sociology and communications professor. And what he studied was how the concept of new ideas, new products, and new technologies spread across the world. And he noticed that they all tend to follow kind of a very similar pattern, which we call the S-shaped pattern, which means that the adoption of something brand new that we've never seen before starts very slowly. It's expensive. It doesn't work very well. No one else really knows about it. Think about electric vehicles in the 1990s. They were ugly. They were expensive. You could go about 20 miles on them. There was no reason to buy an electric vehicle at that point. But a few people did. These innovators, the people that were willing to take the risk to be totally at the far end of the curve on the left-hand side. But as the technology starts to get better and prices start to fall and more people start to buy it, they start talking about the technology to their friends, and you start to see this exponential growth, that it starts to accelerate in its growth rate across the economy. More people are buying it through the early adopters to the mass market, the early majority and the late majority, until finally pretty much the entire addressable market has been penetrated. Everybody that could buy that technology has bought the technology, except the final laggards who are holding out, the people who just won't get a Facebook account or won't get a Twitter account after all these years. The final piece of the market is finally adopting the technology. Now, the S-shaped curve can change shapes, though. It can steepen, it can flatten, it can rise, it can fall. What we saw during COVID-19 was that the S-shaped pattern steepened and increased, which is really powerful for the adoption of these technologies. What does it mean to steepen an adoption curve? Well, it means that people that would have adopted a technology over time were adopting it faster than expected. At Global X, we're a financial firm. We invest in technology. We're pretty tech savvy, but like a lot of businesses, if someone says, hey, we should get Zoom, it goes through compliance, it goes through finance, it goes to the executive team. These things take time under normal circumstances where maybe it would take a couple quarters to finally get Zoom on everyone's computers. Yet, of course, the day after the stay-at-home economy hit, we were told not to go to our offices in March. Lo and behold, everyone has Zoom on their computers. So something that would have taken a few quarters, maybe a couple of years to happen, happened in a day. Similarly, we're not, and Global X is not alone. Of course, I'm sure many of your businesses, you've seen the adoption of these technologies very quickly as well. But beyond the acceleration of the adoption, which pulls forward the growth rate of technologies, we also saw an expansion of the curve as well, a taller addressable market, a bigger addressable market than otherwise expected. An example of this is in e-commerce. So if you ask an e-commerce company or an e-commerce executive, what's your total addressable market? There's things falling out my window. If you ask what's the total addressable market for e-commerce, they would say, well, people aged 18 to 45 are really our key market. We know people in the baby boomer generation from 50 to 70 are increasingly using it as well. Very few executives would be talking about the silent generation, though. People in their 80s and 90s. They're just not considered people that would be using e-commerce. My own 92-year-old grandmother and many people like her are figuring out how to use Costco.com and Walmart.com and Amazon to order things to send to their homes because they're stuck there. They're very vulnerable during the COVID-19 pandemic, and they can't go to the stores that they like visiting on their own. So they need to shop for groceries and shop for home goods and medicine and have it delivered to their door. And what it means is that this whole new market is now being accessed by these e-commerce companies. Millions of people around the United States have now signed up, have used this service, are comfortable with this service, and beyond the pandemic are likely to continue using it going forward because they've had this 1-year crash course on how to use this new technology that frankly they never otherwise would have expected. Now on this chart, you see some tickers here, so I'll explain them, but these are different themes and where they plot along the adoption curve. Generally, the themes further to the left are kind of those higher risk, higher reward themes. They're not as penetrated through the market, so there's a lot more uncertainty. Something like electric and autonomous vehicles all the way to the left, genomics, lithium and battery technology, the Internet of Things, telemedicine, really early technologies that are showing a lot of promise, but still have a long way to go before they're fully adopted, versus some other technologies further to the right on the curve, things like social media, where, as I mentioned, 86% of US adults have a social media account. So it's really just the last few that are going to be adopting that technology. But you can see over time, these themes generally are following this S-shaped pattern, but might be at different stages depending on how new they are. So as I mentioned, during the stay-at-home economy, we saw an acceleration in a lot of these different themes. Working from home is most measurable in the cloud computing space. You can see that as revenues crashed in the S&P 500, cloud computing was churning out pretty good revenues and revenue growth in Q2 and Q3. E-commerce sales grew 45% in Q2 versus a year prior. E-commerce sales only make up about 15% of total retail in the US, but that's a big jump from where it was in Q1 of 11.5%. So suddenly e-commerce being adopted broadly across the technology. And video gaming. People were stuck at home. There was no live sports. There was no concerts. There was very little to do. People turned to video games where they could play with their kids or play with their parents or play with their friends online. And we're using video games as really an increasingly important part of their own entertainment during the stay-at-home economy. So we often get asked about this, okay, that was the stay-at-home economy. That was kind of a weird time. How much is this going to continue after the pandemic? And what we're starting to see is that in a lot of survey data and data from the US government and special groups are showing that a lot of these changes are starting to show up as permanent changes to the economy. If you ask a millennial, are you likely to shop online more after the pandemic than you already are, than already these elevated levels? 50% say yes, 45% saying they're going to increase working from home, exercising from home, 42% using mobile payments. So not only are people going to maintain these elevated levels, but a huge portion of millennials think they're going to accelerate these trends after the pandemic. All of these things that we picked up during the stay-at-home economy, we believe are likely to continue to accelerate. But beyond that, we see other structural changes to the economy. 29 major retail bankruptcies in 2020. And these are brand names that we know a lot about, that we're very familiar with and used to be household names. JCPenney, Century 21, Lord & Taylor. These companies all declared bankruptcy in 2020. They might not reemerge from that bankruptcy. They were already weakened prior to the pandemic as these old brick and mortar stores. But because of the pandemic and the loss of traffic in physical stores, it was really kind of the final straw for a lot of these companies, and they had to declare bankruptcy. So a lot of them are not going to come back, even if doors reopen in 2021 later this year because the pandemic subsides. And lastly, in the unemployment picture, while you're seeing generally a trend of unemployment falling as the economy reopens, what we have seen is an increase in permanent unemployment, meaning jobs that we believe will not come back, jobs that are not temporary layoffs, but completely eliminated from corporate headcount. Part of this can be the bankruptcies we're seeing in the middle. When companies declare bankruptcy, they're probably not going to hire back as many people in brick and mortar stores. We're probably not going to need as many people in hospitality if travel is down permanently after the pandemic. But at the same time, it creates opportunity. We see new opportunities for jobs, whether it's warehousing and logistics related to e-commerce. It could be new jobs in software and programming, because we are seeing this structural changes in this economy where some of the old parts of the economy are getting cycled out and the new parts of the economy are accelerating in their growth. So the reopening economy, where we are today, is a little bit, kind of rhymes a little bit with the stay-at-home economy, but there's some key differences. And I'll point out some of the considerations. First, obviously, COVID-19 not eliminated yet, and we're continuing to see flare-ups around the world. We're seeing renewed fiscal stimulus from Washington to keep the economy going in this kind of reduced capacity. New rules, continuously new rules about social distancing and hygiene and masks as we try to keep up with the latest in the science and the research around COVID-19. companies and people remain risk adverse. So even if we can go into the office, or we can send our kids to school, or we can go to a store, many people are choosing not to because they don't want to put themselves in harm's way, or to potentially spread the virus. There's still travel bans and compulsory quarantines that are still in effect. So clearly we can't do everything. We can't take that trip to Europe that we had planned on. And lastly, uncertainty in some parts of our economy are creating uncertainty in others. If you don't know whether your school is going to be open for your kids, it's kind of hard to decide if you're going to go into the office the next day. If you don't know if you're going into the office the next day, you don't know if you're necessarily going to be dropping your kids off at school. So uncertainty around is just perpetuating more uncertainty. It makes it very hard for us to plan our lives. We can only see about a foot in front of us, taking things day by day during this reopening economy. So what does this all mean? And what does this mean for thematic investing? Well, because of this uncertainty, and because we're trying to get the economy open, but we're also trying to protect ourselves and stay safe, we believe the themes that are very well positioned in this environment are those that are focusing on safety and flexibility. The safety that we can go outside and not be harmed or not get sick, and the flexibility that if one day we're in the office and one day we're at home, we can continue to do the things that we need to do, whether it's our jobs or otherwise. So which themes, drum roll, which themes are best positioned in the reopening economy? There's 4 that I'll briefly talk about today, and I apologize. I know I'm going fast. There's probably 2 hours of material in this presentation for 30 minutes, but Jim, I'm sure, can share this presentation with you afterwards. We'll talk about cloud computing. We'll talk about the Internet of Things. We'll talk about genomics, and we'll talk about telemedicine. 4 themes for the reopening economy. So cloud computing, to go through it quickly, already a theme that was growing very quickly before the pandemic. In short, doesn't make sense for a financial firm like ourselves to be running our own servers and installing software and running our own hardware when you can pay someone else to do that offsite through the cloud. They'll deliver those software to you. They'll deliver updates in real time. You get to sit back, relax, and focus on whatever it is you do, whether it's finance, whether it's medicine, whether it's law. Not a core competency in managing your own IT stack. Offload that to someone else, and we've seen that happen very quickly just in the last 10 years or so. Of course, during the stay-at-home economy, everyone was at home. Suddenly, the ability to access that data remotely on your laptop, on your phone, not only became a nice to have for companies to offload that to a different company to run, but it was a must-have that you had to be able to access all this data through the internet rather than on premises to be able to continue to do your jobs. So we saw huge growth in data traffic as people were using Zoom and downloading all this data from the internet. We saw huge revenue growth in cloud computing companies, despite some of the slowdown in the S&P. So why do we think this theme is better, is well positioned going forward if it's already had such a great run in the first part of 2020? Well, first of all, work from home doesn't seem to be going anywhere anytime soon. If you ask some major employers like Google, Warner, Amazon, Uber, they're telling people work from home for 2021. We don't know when this virus is going to be over. This grand experiment of working from home seems to be working pretty well. So take it easy, don't take the risk, stay at home. More importantly than that, some major employers like Facebook, Twitter, and Square are telling people, you know what, this grand experiment actually worked pretty well. You guys all work from home. We kept doing pretty well as a company. If you want to work from home and you want to move to another, city or state and have a more comfortable life and get rid of that commute, go ahead, you can do that. We'll reduce our real estate footprint. It'll be a win-win for both of us. So a lot of companies, a lot of those employers are telling their employees, this worked, you can stay at home. We're going to continue to subscribe to these cloud services to make this situation work. But it's not just coming from the employers, the employees too. If you ask people before the pandemic, would you like to work from home the majority of your work week? Only about 14% of people said so, 3 days a week or more. Now it's 40 or more percent. So a huge surge in people are saying, I kind of like this lifestyle. I like working from home. Please let me keep doing it. We think this is going to have a really profound impact on cloud computing companies. If you think about 2020, actually, I think a lot of cloud companies kind of did the right thing. They said, we're not going to raise rates substantially. We're going to give away a lot of free trials. You can use Zoom for 45 minutes without paying us. Just use our service. We know you need it, and we'll figure it out later. The figure it out later is 2021. A lot of people signed up for these services. A lot of people got comfortable with it. A lot of people have integrated it into their businesses and their lives. Now's the time where cloud computing companies can knock on people's doors and say, we just increased prices about 20% to make up for the fact that we have you hooked on our service. And so we think we're going to see very strong margin expansion in cloud computing companies going forward. Now, the second theme I'll touch on is the Internet of Things. The Internet of Things, very simply, is connecting devices to the internet, whether it's your phone, whether it's your smartwatch, maybe it's your refrigerator or your car, depending on how new it is. Again, already growing before the pandemic. The main reason why, it's extremely cheap and extremely easy to do so. On the left-hand side here, you see the original Wi-Fi chip that was in the first iPhone in 2007. It cost about $7.40 at the time. Now that same chip, actually a slightly better chip, cost about 10 cents. And it's 1/10 of the area of a dime. So it is tiny, it is cheap. Everything is being connected to the internet because of it. What does this have to do with the pandemic and safety and flexibility? Well, we're starting to see the Internet of Things and all the data that it can collect and all the sensors that are attached to these devices are playing a really important role in stopping the spread of the pandemic. Fitbit did a study with 100,000 users, and they said, give us your heart rate data and tell us you have COVID. And they collected all this data, and what they found out is that they could actually use that data to predict when people might have COVID-19 a day earlier than people would otherwise detect their own symptoms. A day can be life-saving, because that can be a number of people that otherwise would be saved from getting COVID-19, because if you can alert someone on their watch that you might have COVID, you might be infectious, go get tested, go quarantine, you limit that person from spreading for another day. Similarly, in public spaces, we're seeing sensors attached to ceilings and walls, tracking where people go, trying to figure out how close they are to each other, sending people alerts when they get too close, or otherwise taking people's temperatures and trying to sense if they might have a fever related to COVID-19. So we're seeing the IoT being used in very direct capacities to stop the spread. This is being used in businesses, the Global X offices. They scan your face with an iPad and take your temperature when you walk in. Airports, schools, anywhere where there's heavy traffic is using the IoT technology to stop the spread of COVID-19. The third theme that we see really well positioned is genomics. Again, and this is, you'll hear me say this over and over again, another theme that was already growing pretty quickly before the pandemic, but has really accelerated. Genomics is basically the study of one's DNA. Starts with genetic sequencing. If you've ever done 23andMe, you can figure out if you like cilantro or not from 23andMe's genetic-based study of you. That has fallen in price substantially over the last couple of decades. In the early 2000s, it cost about $3 billion to do the first human genome project. And now you can do 23andMe for $100, and it's not that different. So we're seeing rapidly falling costs of collecting genomic data, studying that genomic data, and now using that to do various different treatments and vaccines that can be used going forward. So this has been very critical to COVID-19 since the beginning. If you go back to the SARS pandemic, in 2003, it took about 6 months to sequence the SARS virus using newest genetic techniques. It took about 2 days to do COVID-19. Once they sequenced COVID-19, they could develop the testing that many of you have probably already used to determine if you exhibit COVID-19 in your biosample. So genomics has been involved since the very beginning here. We know that testing is becoming much more widespread to protect people, whether it's the MLB or the NFL or the NBA doing testing, every other day to protect its athletes. A lot of schools are doing a similar approach. A lot of businesses are doing a similar approach for people that still have to come in. It's just test, constantly using that genetic information from the virus and using these tests to understand if people might have COVID-19. But of course, the holy grail, the vaccine. Many of these vaccines use genetics-based approaches as well. Many of you have probably heard of the Moderna vaccine, which uses mRNA technology. Rather than putting a dead virus in someone, it puts the genetic material in someone to develop the virus and then develop the antibodies to fight it off. It's enormously complex, but opens a completely new approach to treatments of vaccines. It's something, they've been working on mRNA-based vaccines for over a decade, but they didn't have enough money and they didn't have enough regulatory enthusiasm around it to get it through the FDA. Because of the pandemic, money flowed in, tons of regulatory support to push viruses through much faster. And suddenly mRNA, which is being used to directly make vaccines for COVID-19, now can treat many, many different diseases. And frankly, I think this is going to be probably one of the most exciting times in the history of pharmaceutical development. The last theme I'll talk about today is telemedicine and digital health, the ability to conduct medicine remotely. Just like we're using Zoom now, telemedicine is basically video conferencing between you and your doctor. It's not a particularly complex technology, but it's something that was very slow to be adopted prior to the pandemic. Healthcare providers just tend not to be very innovative sometimes. If they're used to having people come to the doctor's office and seeing you in person, even if it's for a very quick consultation or a new prescription, they didn't really want to deviate from that path. Of course, during COVID-19, it was very unsafe to bring people into the doctor's office or into hospitals. So they said, stay at home, connect with us on video. We'll give you a new prescription. Unless we really have to bring you in, we're not going to bring you in. And we saw this huge surge in telemedicine usage, and doctors got used to it, patients got used to it, and the providers themselves got used to figuring out how to bill for it. And it added a lot of efficiency to the system, as well as safety. It reduced costs, it reduced inconveniences of having to travel. And we've seen really good results so far in the use of telemedicine. So we think this is a theme where people got kind of a taste of it over the last year. We think it's really going to accelerate over the next few years, and especially during the reopening economy, as we know doctors' offices and hospitals continue to have capacity issues and continue want to keep keeping their patients at a safe distance. So telemedicine is really kind of the fourth theme that we have our eye on. It extends beyond that into digital areas as well, using all this information that doctors can collect remotely to make treatments more effective, to make them more efficient, and even to reform how we even think about healthcare and to make it a more efficient system. So key takeaways: we saw structural changes accelerate during the pandemic, especially during the stay-at-home economy. We saw huge growth in e-commerce and video games and cloud computing. But the reopening economy is about flexibility and safety. It's how we navigate this really uncertain world. And the companies and the themes that we see that really stand to benefit from it are in the cloud computing, Internet of Things, genomics, and telemedicine space. So I think I may have gone a little bit over, Jim. I apologize, but I'll turn it back over to you.
Fantastic job, Jay. We could absolutely do a 2 or 3 hour presentation and all that, but you did a wonderful job. Super exciting stuff. We're really happy to be a partner with GlobalX. Thanks again for your time, and we will speak soon.
Thank you.
Thank you very much, Jay. Really beautiful job. Thank you. Oh, he's got to. I get to take over the host. Jay?
Yep.
If you could just pass the host back to me.
That's right. We talk about cloud computing, and yet I still screw up.
Right. We're using all of your thematic themes today. Everything, all of our tech powers right now.
Let me see here. I'm pretty good with Zoom, but for some reason I'm not finding the share.
So go to the participants and then go to mine and then make host.
There we go. Sorry about that, everyone.
Great. All right, terrific. We're here. All right, so we've still got about another 30 to 40 minutes left. This is the best part, right, everybody? I thought Jay did a wonderful job. And like we said before, GlobalX is a great partner of ours. A lot of you own some of these things already. And we've been, following GlobalX for 2, 3, 4 years. So we're managed to pick up a lot of that intellectual capital and, bring it to you and your money. So without further ado, I'm going to talk about these 3 things. We're going to talk a little bit about 2020. I'm not going to go over a lot of it because it wasn't a great year. So good riddance to 2020. So where are we now in the market? Where's the economy? Where are we now and where are we going? So this is kind of my favorite part to talk about. So please stand by, stay tuned for the great prediction. So we're going to probably be doing another 35 minutes or so. Please stay with us. And we're going to have a question and answer. I'll stay as long as possible because I'm here in Westlake. I am exactly 8 miles away from home. So I'm happy to stay and answer any questions. And if you have any questions for Jay, just email us. And he promised that he would absolutely love to answer any of your questions about what he does and what they're investing in. So a few weeks ago, we had a poll and we sent out a poll. We had a lot of response. Thank you very much for all the terrific responses. We have a lot of great data and it was very interesting, some of the results. So I'm going to sprinkle some of the results throughout my talk and it'll get us to think about just exactly how everyone's thinking about some of these important issues. So let's go back to 2020 briefly. It started off poorly and it got worse. We had the death of Kobe. We had all kinds of geopolitical events. We had the impeachment of President Trump. Of course, we had the COVID, which led to a stock market crash, which led to global lockdowns and a recession. It's almost horrible just to even remember all this stuff. Then we had the George Floyd death, which led to civil unrest and protests, which also I wanted to make certain that we talked about the Supreme Court vacancy. And this one really hurt me. Guitarist Eddie Van Halen died last year. And of course, we had an awful, contentious election with really the results taking weeks to really ratify. So I would give 2020 maybe a half a star, maybe 0 stars if we were giving it a rating. I would absolutely not recommend it. Nobody would. So it wasn't all bad. Just like Jay said, hey, we were early adopters. Now we're late adopters. We all learned about Zoom, right? And it has changed the way that we communicate, changed the way that we do business, changed the way that we stay in touch. It's not going away. So I commend all of you for joining us and utilizing the technology. We appreciate that. So a lot of people don't know that Zoom has been around a pretty long time. Does anyone know how long Zoom has been around? It was created by Eric Yuan in 2011. It went public in 2019. How convenient, a year before COVID. He is now a billionaire. But really, we know that it's the Brady Bunch. They've been using it since 1969. Memories of that, right? So, of course, there's a lot of funny memes too. And this is one of the funniest ones. I had a couple of memes. You said you were sick. No, I said I have a case of corona. Ha, ha, ha. But that one was funny. This is probably one of my favorite ones. So everyone was worried, how are we going to get COVID? Is my dog going to get COVID? Should we quarantine the dogs? But so the World Health Organization, WHO, announced that the dogs cannot contract COVID-19. Dogs who were in quarantine were let out. So to be clear, I thought that was really funny. Anyway, moving right along. And then, of course, we could not go to the salon. We were all locked up in the salon. And we know that parents are the worst hairdressers in all of creation. We saw some bad haircuts. And then travel plans. I know a lot of you clients out there love to travel with family all over the world. Obviously, that was curtailed and it still is. So this was looking at a map for some weekend travel ideas, moving from the kitchen to the bathroom to the den. Thought that was kind of funny. So there was some really good things that happened also in 2020, and we all got a lot more quality family time. And I'm happy to announce that Tara bought a house. Congratulations to Tara. Her and her family bought a house, first-time home buyers. Ryan had a great year too. He's expecting another child early, in the next couple of months. Congratulations to Ryan, Brittany, and Pierce. And congratulations to Jenny and Russ are now engaged. We're super happy for them. And then there's the Elios family. I'm not doing any of those things, but no, we are happy and healthy, and I hope everyone else had more quality family time. So moving right along, I just wanted to mention that, hey, drive-ins had to come back. So I got to see a drive-in twice last year. That was a lot of fun. And this is something super positive, and I want to thank everybody for your support. I've been riding my bike and raising money for cancer research. Last year, I had Nicole, the director of Velasano, speak, and she sends her warm wishes to everybody in the Elios financial family. We raised another $5,000. They had a virtual Velasano, but I had a really great little adventure down to Hocking Hills. Thank you so much for your support. Without you out there, my wonderful clients and friends, I couldn't have done it without you. So thank you for your support of Velasano and cancer research. And of course, How can we forget about the Browns? What an amazing year that the Browns had. Yep, that's the old theme of the Browns. I've been waiting, and I know a lot of you out there, diehard Brown fans like me. I've been a fan since 1975, was when I was in third grade. Finally, we made the playoffs, and even sweeter to all you Pittsburgh fans, we beat the Steelers. And it was very, very satisfying, very, very exciting for Cleveland sports fans and the Browns fans. And I look forward to beating the Steelers again twice next year. So anyway, but this is probably the best news that we had last year was the record-setting speed of the vaccine. As Jay talked about, dramatic structural changes and dramatic innovative technologies. The speed of the vaccine was spectacular. And I did a little bit of research from from identifying the pathogen to creating the test to actually developing vaccine within a year is spectacularly fast. The last time that we had a vaccine was for the mumps. It took 4 years. What it took 4 years now took less than a year. So the FDA approved it on Friday, December 11th, 2020. And it is now being unveiled. In fact, I took my mom, this is my 86-year-old mother, I took her to the Fairview Cleveland Clinic yesterday. This is my sister. And it was absolutely a smooth and a very quick and orderly vaccine. And she has to go back for her second shot in a couple weeks. So I encourage everybody to look into that. So when did the WHO, the World Health Organization, declare the pandemic? That was March. I can't believe how much has happened since March 11th of last year. That really changed our lives, I think, for a long, long time. So then what happened? Then we had the fastest drop in the stock market ever. In 22 short trading days from February 19th to March 20th, the market dropped 31%. It was nervous times. The uncertainty of a pandemic coupled with a dramatic stock market decline was really unsettling. It was unsettling for a lot of clients, and it was unsettling for us too. But the clear thing that I can remember thinking about, what went down so fast must be temporary. And we stuck to what we were doing, and obviously it worked out well. We had a spectacular recovery as well. So after the pandemic declared, a steep decline, and then we had a very nice recovery all throughout the rest of the year. In fact, the NASDAQ is, at an all-time high, and the S&P went up about 15%. So through all the COVID, the lockdowns, the election, the protests, we still had a solid year in the stock market. And so this is my humble brag. Last year, I stood in front of you at Le Center, and I thought we were going to have another good year. No way in my wildest dreams did I know that we were going to have this tumultuous year. I thought we were going to continue through the election and that we were going to do 15%. So lucky me, we predicted exactly 15%. So please stay tuned for my prediction for 2021. So if we look at the 2 years of 2019 and 22, it was really two solid returns in the stock market. And we're saying the stocks did 29% in 2019 and 15.5%. What a tremendous 2-year period. The NASDAQ even better. So where are we now? Where are we headed in the markets, in the economy, and the stocks? I love doing all the research, and I spent a long time kind of looking at all these different compelling issues, coming up with what I think is going to happen for the rest of the year. It's always an exciting time to do this talk. It's never a dull moment, right? So I'm calling this, well, the Chinese New Year is the year of the ox. And I think that's really interesting because ox is another name for a bull. So we are somewhat bullish, and then I try to figure, okay, what's the difference between an ox and a bull? And it's real simple. The ox is a castrated bull. The ox is actually used for agriculture. Those are what, plows the fields. They're more cautious and they are more orderly. And I hope that that's the metaphor for 2021, so the year of the ox. So here's the 5 things that we're going to be thinking of. And as we looked and studied, obviously we have a new president, we have a new administration, and we have a new Congress. I'm going to talk a little bit about that and talk about the implications of the politics. And then we're going to tell you a little bit more about the vaccine, the latest, and how the economy is opening, piggybacking off of Jay's terrific comments about the reopening economy. And then really what exactly is happening with the recovery and what I think is going to happen. And we're going to talk about what the government is doing to support the economy, what the economy, or support people that have lost their jobs and so forth. And that's a big issue. And then I'm going to talk, and I think this is one of the most important things that I'm going to address, is exactly how expensive is the stock market now after 2 significant years. Are we overvalued? Are we undervalued? And where do we see the growth coming from? So in our poll, we wanted to talk about the election. We wanted to get a barometer of where everyone was thinking about with the election. Obviously, it was contentious. So do we think that there was any voter fraud, prove it or not, in November? And I think the results were kind of interesting. 43%, not at all. There's no voter fraud. Some were unsure, and I think that's a growing number of people possibly. I say possibly. 33 said possibly some evidence of voter fraud. 12% think that, yes, there was fraud, but there's no change to the results. And then interestingly, 19% said, yes, there was some fraud and it probably changed the election. So if you look at it, it's not surprising that we're still divided. 54% of the respondents to the poll thought that there was some voter fraud. Half of it were unsure or did not think so. And then I wanted to get a gauge of how confident people were with the new presidential administration. Obviously, that just happened. The inauguration was last Wednesday, and it's all new. So how confident are you that the new administration will be able to effectively deal with the challenges? So 15% said not at all, 19% had little confidence, and 21% were unsure. But then the other side said 31% were confident and 2% were extremely confident. Again, we're divided. A third say not confident, a third say confident, and then the rest of us are still unsure. So one thing is absolutely true. The election is settled. And I know there's some conspiracy theories still out there. I think that's going away. But the Electoral College said Joe Biden got 306 and Donald Trump got 232. It's settled. Obviously, it was contentious and it's over. No matter what anyone thinks, we're all moving on. And in 2 short years, there's going to be a midterm. That's our system at play. It's a wonderful system of checks and balances. So the Joe Biden administration is here. So there's a lot of promise. There's a lot of hope. There's a lot of discussions. There's a lot of executive orders that are being signed. But what I want to know is, how long will the honeymoon last? A very recent poll said 63% people give Joe Biden high approval numbers right now. And right now there's a period of calling for unification, and it's all calmed down. And I welcome that. But if there's any sign of, a partisanship and all that, his honeymoon could end soon. So we're going to keep a real close eye on all that. And we know about the Congress now. The 117th Congress is extremely divided with the narrowest of margins. We had the Georgia election, and the Democrats picked up 2 more seats in the Senate. It's 50-50, and we all know that the VP now is the deciding vote. And then in the House, Republicans picked up a number of seats. That's a lot closer too. So we have extremely divided government. There's not a lot of majority here. It's very, very close. So I am calling this the gridlock scenario. This is the scenario that I outlined when we looked at the election last October. It's gridlock. It's one of the reasons the market has done pretty well since the election. But it's also important to know that any dramatic policies that either Biden or the Democrats were campaigning on, it's going to be very difficult to pass. Getting 60 votes is going to be difficult given the current makeup. So there's a very important concept here that I think everyone should know about, and it's called budget reconciliation. What is it and why should I care? So this is a procedural apparatus, if you will, that the Senate can use. And it requires only 51 votes to pass anything related to money, anything related to the budget, taxes, and spending. I'm oversimplifying this, but they can use this technique, this procedure with 51 votes. Major tax and spending laws can be enacted. This is a really important thing. So here's your three favorite people up there, right? Pelosi, Schumer, and McConnell. Obviously, McConnell used to be the majority ruler. He is now the minority person. And now Pelosi is still Speaker of the House. So in the past, major legislation was passed with 51 votes. The Clinton welfare reform in the 90s, in the early 2000s, the Bush tax cuts, Obamacare, and the Trump tax cuts. We're going to be watching this really, really carefully. So you might think this is a dumb question. It's a rhetorical question. Do you think taxes are going up? And my short answer is yes, but it may take a while. So I'm going to just do a brief tax scenario here. So candidate Biden proposed $3.4 trillion of new taxes because he's got a lot of great spending plans, infrastructure, climate, education, and healthcare. Terrific. How are we going to pay for that? He is proposing some real big changes. Again, these are proposals. And one thing is absolutely clear. If your income, and a lot of this is geared towards higher income. If your income is up, if you're considered a high earner, $400,000, absolutely a lot of these issues are going to be passed and taxes are going up. Capital gains as income, that's significant. Losing the step up in cost basis. Social Security going up. Higher individual rates. Now, for the lucky ones out there that are making $1 million, and your taxes are absolutely going up. So it depends on how it's going to be negotiated in the House and the Senate. Those income levels could be pushed down. They could be pushed up. That's where all the negotiation is. So what was current law and what Biden's plan is a big difference. We're going to be really watching that carefully. But again, right now, we think it's for higher income. A lot of the planning things that we're going to do, and we're going to mention that in a few minutes, the Roth conversions, we're going to look at the current tax codes and see what we can do to mitigate taxes and to create tax efficient investment and financial retirement plans. So anyway, now I'm going to pass this on to Ryan now, and he's our resident CFP and also resident COVID and vaccine expert. He's going to spend a couple minutes giving you the latest. So I present to you, Ryan. And go ahead, Ryan. Yep.
Okay,
yep.
Great.
Looking good there, in the West Wing over there.
Yeah. So, we want to first start off, we had a couple of survey questions. And we had 90 responses. So the first one we just wanted to touch base on is, how concerned are you or someone close to you, a loved one, how concerned are you still about contracting COVID-19? And this is the least surprising response we received on the survey. So, no one thinks that they're in the clear just yet. Absolutely no one is not concerned at all. So, some people are slightly concerned, but the vast majority, of our clients are, it's still a problem. It's been a year and we still feel kind of the fear from COVID and, we might still be quarantining, certainly masking up. So The second question we asked, this was a little bit of a surprise for us. So, we know some clients, have notified us that they've had COVID, but ultimately, we asked, has someone in your household or yourself, of course, tested positive? A quarter of the respondents, said that they have had COVID or someone in the household that had COVID. So that one, took us by surprise a little bit. And, I think all things considered, we've heard enough about how COVID has affected everyone over the last year. We just want to take a quick kind of gander at where we're at right now. So, on this slide, this kind of lets us, know why we're cautiously optimistic at the time. And it's a recurring theme that we're going to touch on, over the course of the night. But, ultimately, we've seen a lot of progress made in a short amount of time, since the beginning of the year. We're actually about 100,000 cases below our peak towards the beginning of January. That's daily peak and also 7-day average peak. So, we've made some pretty rapid progress, and that could be partially due to more people contracting and, surviving the virus and having antibodies, but it's significant practice and pretty rapid time. And it's really coming at a time where perhaps a seasonal uptick might have been expected. So, and going along with the new cases, our hospitalizations, they were kind of getting out of hand toward the end of last year. Concurrently, they've been decreasing daily for the last 2 weeks now. So, while there's still pockets of concern in some cities and some regions, but domestically, in terms of new cases and hospitalizations, we're trending in the right direction. But by no means are we out of the woods, though. On our next slide, as you can see, COVID deaths are still an area of concern, and there's even been a little bit of a rise. So this takes us through January 21st, I think. Been a rise in the last couple of days as well. So we remain near our peaks in both daily deaths and 7-day average deaths. And I know we've heard this over and over again about how the deaths are kind of a lagging indicator, and it comes a couple of weeks after hospitalization. But we're really kind of in that area where we might anticipate seeing some decline there. So, hopefully in the next week or two, we'll be able to see some progress in this area. But, the reason for our overall, cautious optimism is no doubt, as Jay said, as Jim said, in record time, we've developed vaccines. And so we asked you that question, are you interested in taking the vaccine? And it shouldn't be a surprise. Most people not only are very interested in taking the vaccine, they're interested in taking it as soon as possible. So there's been some misinformation and there's been some politicization about the safety of the vaccines. Doesn't seem to have affected us, and the numbers are trending in a positive direction for all of America. But with 2/3 interested in receiving it as soon as possible, it's an optimistic sign. So. Of course, when it comes to the vaccine, there's good and there's bad news there as well. So there have no doubt been issues. As you can see, there's still under 10% of the population has even received a dose. So, there's been supply chain issues, there's been transportation issues, communication issues. There's been some, prioritization of some populations who aren't at risk over people that are, our most vulnerable populations. So, all things considered, though, considering our first confirmed case was just about a year and a day ago, we've made some pretty substantial progress. Like I said, 10% of the population has received at least one dose. There's actually about 1% to 2% now that have had both doses. So one other thing, and this slide is really, really interesting to me. So we've heard the term herd immunity bandied about, over the last year, and it's kind of faded from the lexicon lately, but it was a buzzword at the beginning of the pandemic and became a little politicized here and there for the cases for or against government lockdowns. And usually when it's brought up, though, it's a kind of a herd immunity or bust conversation. So, there's been debate, is it 70, 80, 90% that's required to kind of stunt the spread or really eradicate the disease. So one aspect that's not discussed is the correlation between the population that has immunity and the decrease in spread rates. So vaccinated or recovered people have antibodies for at least a period of time, and they break the chain of the spread of the disease. So while herd immunity refers to the complete eradication, the more this number ticks up, the better. The slower the spread should be, and the closer we get to herd immunity, it should be a pretty exponential slowing. So This is a graph from the U.S. Bureau of Economic Analysis, and it estimates that we had a holiday uptick, and from Thanksgiving really to Christmas, and in addition, we're vaccinating people now. We think it's over 1/3 to 40% that at least has temporary immunity or defense to the disease. So now there's certainly cause for concern. I mean, we have identified variants which are a little bit more stubborn when it comes to treatments, and they may respond a little bit more hostilely to vaccines. But there's also there's promising developments that could be coming in fairly short order. One of the things that we're keeping a huge eye on is Johnson & Johnson is really, in the final days of their final stage of the vaccine that they've, produced. And we kind of anticipate the results any day, probably next week at the latest. And whereas, the current vaccine options are 2 doses, and the transportation and storage of those vaccines is, it's not easy. The Johnson & Johnson, it could be a little easier and certainly more efficient. It doesn't require deep freeze. It's just standard refrigeration. And of course, 1 dose, speeds up the time that people would have immunity. So, and Johnson & Johnson is a behemoth, and they're targeting 1 billion doses by the end of the year, 100 million of which are kind of going to be targeted domestically. So there's another 1/3 of the population that could have access to a 1-dose vaccine by the end of the year. So we're watching closely, and ultimately, we're encouraged by the progress we made outside of everything. And more good news could really be a catalyst to kind of kick the economy into gear and give people the confidence they need to go out and attempt to return to normalcy. So I think that's a good segue to kind of get going.
Great job, Ryan.
Yeah.
Right. So we think that obviously there's a direct correlation between, the vaccine, everyone either having getting the vaccine, having the disease already. And, as that graph showed, that's a direct correlation to the reopening and getting the economy back to normal. So here's a poll. So how does everyone think about the economy? What is everyone thinking about? Are we, getting better? Are we going to stay the same? But this one did not surprise me. Compared to 2020, the economy in 2021 will be, and this again, our poll, some people thought 8% it would be much worse. 21% slightly worse. So right now, that's almost 1/3 think it's going to get worse or not better. But a lot of people think it's, 1/3 is going to be about the same as last year. And then slightly better was 33%, and then booming. So if you look, 70% really think it's going to be the same or better. And obviously, I think that's probably in the right direction. So let's take a look. Is the economy recovering? Absolutely it is. And again, we looked at some of the data. The 4 most important things to look at are employment, production, retail sales, and real income. As things started opening up again, as the lockdowns were loosened, all that stuff started coming back. There was a second wave here, like Ryan had mentioned in November and December, lockdowns increased again, and then we saw some red. But in general, the trends are good. It's directly coordinated to the reopening. And just having the vaccine wasn't enough. Now people are saying, I am not going back to work until I get the vaccine. I'm not going back to school until I get the vaccine. That's going to take some time, the logistics of it. But the economy is getting better. And there's absolutely trends. And this is the big one. I mean, this is very recent. I mean, it was an extraordinary number of people who claimed unemployment insurance in March, and April was the peak. Obviously, you see that's come down right now. And we just saw another lower tick to 680. So people are now getting back to work, or they're getting back to work. Obviously, that's a really good sign. Consumer confidence just bottomed out in the summer in June. It was extraordinary. We've never seen a bottoming out. This goes back, 23 years, or excuse me, 13 years. We haven't seen this low of confidence since the financial crisis back in 08, 09, when our whole financial system collapsed. But it was a huge drop from the very high levels that it was just a year ago. and it is slowly coming back. The latest figures are that it's starting to tick up. Consumers are getting more confident. The vaccine is here. People are going back to work, going back to school, and they're still consuming. And now, that's going to take some time, but I think consumer confidence is an absolutely essential part of a strong economy, which leads to a strong stock market as well. But and I've said this, throughout this last possible year, it's the alphabet of the recovery. Are we having a V-shaped recovery? Is it a W? Are we going back down to another, recession? Is it a hockey stick? Is it a check mark? What is it? Well, it's pretty clear now after a year, it's been a V-shaped recovery for a lot of people. The V-shaped is everyone who could Zoom, who could work from anywhere, people who did not lose their job, people that maintain their job, all people who are long-term investors, all that segment of the population, which is probably all of us on this call, has experienced a V-shaped recovery, thankfully. But I want to acknowledge, and this is absolutely true, I want to acknowledge that there's a segment of our population that is not experiencing a V. This is the K. This is that leg down. This is the people who lost their jobs. Small business owners lost their businesses, bankrupt businesses. A lot of the data is coming out. 29 million people were facing food insecurity. It's exactly what Mary was talking about with the Greater Cleveland Food Bank. I mean, there's still people out of work and people still struggling. I think that is slowly going to change, but it's going to take some time. So the Federal Reserve has done their part, and there's, I think the most important part of this is that interest rates are super low. They are going to be low. This is Jay Powell, the Federal Reserve President. By the way, he is continuing to be the Fed president in the Biden administration. Janet Yellen, who was the Fed president, is now Treasury Secretary. So that might be confusing, but so as Federal Reserve Chairman, his job is monetary policy. That means that he can set interest rates low. And they did. They put rates down to zero as a crisis level. We haven't seen these rates this low since, again, the financial crisis 12 years ago. And I think that was a very beneficial thing. What that did is drove interest rates down. And it allowed Tara to buy a new house. A lot of people are buying houses, refinancing their mortgages, buying cars, paying off credit cards. I mean, it's an interesting time right now with people making about the same, spending less, and refinancing their debt. There's more cash flow. Americans are doing better right now. And what's really interesting is if you look at U.S. household debt service, when you have really, really low rates, the percentage of your income going to pay off, pay the mortgage, the rent, the property taxes, the insurance, it's at the lowest on record, at least since 1980. 1980. So that is a positive thing. We're seeing some of that make its way to the stock market. I'm going to talk about that in a minute. So low rates are generally really good for consumers. So a lot of clients come to me and they're worried about the debt. Hey, we're spending all this debt. What are we going to do? Can we afford this debt? It's an enormous amount of money that we're throwing at this virus and to support people who lost their job. But as a percentage of our GDP, because rates are so low, we can afford it. We can afford it. In fact, our debt service as a nation is the lowest it's been since a long time ago. I mean, back in the 1990s when rates were really high, we were spending a lot of the interest payments servicing the national debt. It's probably back down right now. This graph is about a year old. But the problem is when rates go up, it's not if they're going to go, it's when interest rates go up, then we're going to face a pretty big problem. So this is, when I talked about federal stimulus, so the Federal Reserve lowered rates, there's an incredible amount of liquidity in the market. And then our government has passed a number of things. In March, the CARES Act, that's a $2 trillion program. In December, another $900 billion. And then Biden is now, and Congress is proposing another $2 trillion with a T relief package. You add that up, that is an enormous amount of stimulus and new debt. And it shouldn't surprise anybody. I mean, I don't know if anyone still cares about the debt. I mean, we used to care that our nation wasn't in debt. And this is something that I've been following since I studied economics back in the 80s. So we are now at a pace of about 100% of our GDP. In other words, if you took all the goods and services of the country and added it all up, that's as much of debt we have. We have 100%. We have not seen those levels since World War II. But the problem again is the projection is going to get astronomical. So, if anyone is listening that can call their Congress or their senator and say, hey, what about the debt? Where's all the spending going? I urge everyone to think about that. So with all that, I mean, that's one of the reasons the stock market is going up. But why does the market keep on going up? It was extraordinary what was happening since the election. We're up 11 to 12% just since the election. So I would just summarize it this way. The uncertainties that we had last year have become certain. The vaccine is here. We know the efficacy is certain. It's going to work. It's just a matter of time that everyone gets it. That's a certainty. The reopening of the economy, it's not when, it's not, if at all. It's just when, I'm sorry, it's not if, it's when the economy is opening. We're going to be able to fly and travel and go back to school. That's certain. The economy is going to grow again. The election is over. That's certain now. A lot of people may disagree with that, but it's absolutely certain. And the companies, this is all of Jay's thesis. I mean, companies can manage and thrive. There's going to be winners and there's going to be losers. Companies can and manage. That's certain. So again, I talked about since the election, the market's up 11%. Now we're seeing small caps go up too. There's a breadth to the market that is going up. And I think that's positive. So after 2 years, where are we now? We're pretty much close to all-time highs. And that makes some people nervous. Are we in a bubble? I'm going to talk about that in a second. It's been extraordinary, especially the NASDAQ. The NASDAQ is up 100% in the last 2 years. What pandemic? But the stock market in general is up 50% in the last 2 years. So if you took that middle area, that pandemic out of the way, it would be 2 incredible years back to back. And I'm really, really proud of the money and the Elios growth and income portfolio. I'm really happy with the results and proud of all the work that we put into to create balanced portfolios for all of our clients. So in general, in 2019, a moderate 60-40 portfolio did about 15 to 18%. And last year, with a couple of rebalances that we did timely, most clients had a 9 to 16% rate of return. So 2 really good back-to-back years, and we're real proud of that. So this is coming up a lot. The Wall Street Journal. I mean, CNBC is in a fever right now because of what's happening in the market with the bubble. And so are we in a market bubble? There is a lot of indications, there's a lot of little bubble things happening, and I'm going to talk about those. So E-Trade Financial just came out with their survey, and they surveyed clients or investors who have been invested in the stock market for quite some time. 16% think that we're fully in a bubble, 46% it's somewhat in a bubble, 29% think the market is approaching one. So 90% of investors surveyed think we're in some type of bubble. Count me in on that. I'm going to make a distinction though. There's areas that are overbought. There are areas that are fully in a bubble, but not the entire market. I think it's in spots, and I want to highlight a couple of those spots. So this is what's happening here the last couple of days. I mean, everyone knows what Robinhood is, and if you don't know what Robinhood is, ask your kid or your grandkid. It's on your iPhone. It's a app that you can buy and sell stocks for free. James, if you're out there, my 16-year-old has that on there right now. A lot of these millennials are first-time investors, and they are buying stock, and they are reading chat rooms. Does everyone know what Reddit is? Reddit is a chat room. So they're talking about stocks. And not to complicate what was happening, but a lot of these youngsters are telling everybody to buy the stocks that some of the big firms were betting on going down. So they were just taking the other side of the bet. And it's caused a lot of the big Wall Street firms to take notice, because when all the millennials are buying the stock, the price has gone up astronomical. And the poster child of that one was GameStop. I mean, this is a failing business. No one goes to a store. I mean, it's like Hollywood Video. No one goes, rents videos anymore. No one goes, buys games anymore at the store. They just download them now. So this stock is incredibly gone up 1,000%. So that is a sign of a bubble. And we're going to avoid that stuff. I think that stuff is going to go away as soon as these millennials see money can be lost quickly that way too. Right now, they're only seeing the upside. They have not seen the things that I have seen, that we've all seen, like the tech wreck of 1999 and 2000, the financial crisis of 2008 and last year. They think, hey, investing's great. Everything goes up, especially if you started investing the last 9 months. Anyway, there's other signs too. And this one, everyone knows about Tesla. Everyone, knows Tesla. It's a great company. I own the car. I love the car. I love EVs. I think it's here to stay. I think everyone's going to be driving an EV, but Tesla should not be going up 700% in 1 year. And Bitcoin should not be going up 300%. The third one I have on there is Apple. Apple is amazing. Apple just made $100 billion. They came out with their earnings. That was up 80%. I mean, that's legitimate, profitable company. These are signs of a bubble. So, and another thing too, this is another scary thing, is that the number of stocks that are up 400% from their peak is now nearing that internet bubble phase. It's a little bit of a concern, because I think a lot of you remember what was happening, the frenzy, the maniacal trading of the internet bubble. It's gotten much faster now with technology. So what about Bitcoin? People are talking to me about Bitcoin. And, a lot of that was part, if you look at Bitcoin, it was the best performing asset class in 2020. But it's interesting because 4 years ago, it did the same thing. It was the sort of the traders and the rich, get rich quick people. And I avoided it. We avoided it. But you know what? I've sort of changed my approach to Bitcoin. I think now it's a legitimate, investment. So I wanted to talk about this real quick. Has any of you ever forgot your password on anything? I mean, our whole life is ruled by passwords, right? So there's a funny little story here, quick story, is that Stefan Thomas, he lost his password, but it's going to cost him if he cannot remember his password. He's a CEO of a tech company out in Silicon Valley. He's young. He worked on a project 7 years ago. He did some technology project, and the people who hired him said, hey, Stefan, do you want to be paid in dollars or do you want to be paid in Bitcoin? And being the young millennial and knowing about Bitcoin, he said, hey, pay me in Bitcoin. His $7,000 is worth $200 to $300 million now. It's unbelievable. But he can't remember his password. So you could look him up. He's on Twitter. He's admitting it. He feels bad about it, but he's moving on with his life. That's kind of funny. So what about Bitcoin? The fact is there's a lot of sophisticated investors who are investing in it. We're talking about hedge funds, some of the smartest investors in our economy right now, family offices, hedge funds, the endowments of Harvard, Yale, and University of Michigan are slowly buying some of this. And so now I've come to the conclusion that I think that this should be part of someone's long-term portfolio. I'm thinking cryptocurrency is an alternative asset class, maybe alternative to gold or the US dollar. There's safer ways to buy it. There's more liquid ways to buy it. And about 3 weeks ago, we added a small amount of Bitcoin in everyone's retirement portfolio. So please look for that. And I think it's a small piece, but I want it to be part of a diversified portfolio. So if you have any questions about what exactly that is, please let me know, and I'll be going over that in our reviews. So quickly, I want to talk about, is the stock market fairly valued right now? Should I be putting more into the market? Should I be trimming? Is it too expensive? I think this is a really important part. So this is where we spent our time researching. So there's really 3 ways to look at it. So valuation number 1 is Warren Buffett, really my investment hero. He is one of the most successful investors of all time. I know everyone's heard of Warren Buffett. His method just talks about price and earnings. And it's kind of troublesome to see his indicator saying that, hey, we're even beyond the valuations of the internet bubble of 2000. So in one measurement, the Buffett indicator, stocks are strongly overvalued. The second method is just looking at PE ratios. And Bob Picciarelli, if you're out there, this is based on the email you sent me a couple months ago. This is another way to look at the valuation. PE ratio, how expensive is a stock based on the profits it earns, based on the earnings. And right now, unfortunately, we're 2 standard deviations away, and we are in an overbought, overvalued scenario. I think the PE ratio right now is about 20 for the S&P. We are overvalued. Now, there's one other method that is, I think, really, really important. It's the PE ratios, but it's talking about interest rates. It's calculating how stocks are valued in a low interest environment. So one thing is that there's no other alternative for money. You cannot make a rate of return on interest anymore. There's no bank accounts or any, safe instrument that is going to pay you interest of anything of real significance. Rates are really, really low. So a lot of that money has migrated to stocks, but it's also a measurement of how companies can borrow money and leverage. They've been borrowing money and refinancing, so they have more money to spend on plants and equipment and employment. So if you look at PE ratios and the interest rates, we are fairly valued. So I would say, much better valuations than in the 2000 when interest rates were really, really high. So we're getting towards the end here. So what do I think is going to happen this year? Looking at all the things we just talked about, I would say we are ox-ish. We're not quite bullish, we're ox-ish. And if you were here at the beginning of my talk, an ox is a bull, but it's been limited. It's a little more cooperative and it's not as strong. So I would use that sort of a symbol or a metaphor. We're oxes, we're cautiously optimistic. There's reasons to be optimistic. We've talked about them. The vaccine, low rates, huge stimulus. That money is gravitating to stocks. One thing we really haven't talked about is China. China is probably ahead of us. Most people know, or we think we know, that that's where the China virus or the virus came from. They did a massive lockdown. They've opened up. Their economy has grown quicker, and we think that that could be a template. Asia is growing quickly. They're used to having vaccines. They've been wearing masks for a long time.
So we can use that as an indicator. Company earnings are going to get better. A lot of them had difficult times last year. It's going to get better. And the fifth thing is, one of my favorite things to talk about for the future is exactly what Jay talked. We're talking about the macro thematic digital transformation that's been accelerated through COVID. That's not going to stop. The way we shop, the way we go to school, the way we work, the way we entertain, all of that is changing, and it's changing quickly. That makes me bullish right there. So our top themes, I've talked a lot about ESG. ESG is bigger than ever. And I'm happy that we were sort of ahead of everybody in this, that we want to screen our investments for companies that are forward thinking, that are risk managers, that are saying, hey, no matter what happens with climate or with social issues or whatever, we want to be ahead and we want to be profitable. It's not a political thing. It's an economic thing. We're also going to be looking for value. What hasn't gone up? The travel, the leisure, other value stocks. I hate buying things at the top. I like to buy things value. Where's the value? Small caps and international are an opportunity. We're still going to use bonds. We're going to rebalance. And then the thematic things that Jay talked about, now there's more politics to it. What is this administration going to be pushing? Clean, sustainable energy. We've already been doing that. Health tech. We talked about amazing technology that Jay talked about. Infrastructure spending, digital currency. It's legitimate. And then EVs and battery technology. I mean, EVs get a lot of attention. I have been driving an electric car for 3 years. I love it. I will never buy a combustible engine again. And I think a lot of people will move towards that. So in terms of financial planning, and I'm happy that we were able to, create a plan for everybody and manage through a plan. So, having a plan, you're already ahead of so many other people. We're going to continue to do the tax planning, Roth conversions, new estate planning ideas with IRAs, rebalancing and diversifying. We're always going to be looking at, managing the risk, tax loss harvesting. If and when we get some type of market correction, and hold on to that thought for a second, a market correction, we're going to be able to realize some losses that'll offset some gains. Again, looking at the long-term effects of taxes and how we can help mitigate those taxes. So what are the pros saying? I always survey some of the top people, and I have to say the pros are all pretty optimistic or cautiously optimistic. Very few people are calling for a bad year, by the way. So Jim Paulson, he's on CNBC all the time. He is calling for a correction, but higher at the end of the year. And I am very close to saying the same thing. Here's someone new that I follow, Lisa Erickson. She says, hey, profits aren't there. It's still lockdowns, COVID, lockdowns and all that, what I said. Market's just going to go up very modestly. And then one of my very favorite market economists and forecasters, Brian Westbury from First Trust. As you remember, last year I had an economist from First Trust. He's been right a lot. I follow him really closely. He's saying, hey, it's about the math. Profits and interest rates drive the stock prices. He's calling for a 12% gain in the market. And then you wonderful clients out there, thank you again for taking the survey. We took a consensus of what everybody said. And most people in this audience and most people that work with us are cautiously optimistic, somewhere between a flat and 10% year. And I have some of the smartest, knowledgeable clients. I think that's a really good guess. And then here we are. Here's my market forecast for 2001. Drum roll, please. I'm Oxus again. But sincerely, with these little bubbles in the market, there's got to be a correction. I'm almost hoping there is one. There's too much froth. There's just too much expectations that the market goes up all the time. It doesn't. And some people need to learn their lessons, but I am not worried. I don't want you to worry about a 10% correction because that's going to be temporary. The only way that turns into losses if we act rationally about the correction. In fact, I would like to be adding and buying the dip when we do that. But I think we're going to have a stronger second half. We're going to be diversified. We're going to rebalance. I'm saying it's going to be somewhere around 8%. I'll take 8% after 2 really, really good years. So, and finally, one last thought. Everyone knows that the Cleveland Indians have decided to change their name. And a lot of people did not want, in fact, 76% of the people that we polled did not want the Indians to change. And I was kind of one of them. I like the Indians name, but it's not our choice. They're going to change it. So we took a poll to see what everyone picked. So obviously Chief Wahoo is long gone and the Indians name is long gone. So here's what everyone said. 17% like the Spiders, 25% like the Rockers, 32% like the Guardians. And again, that's paying homage to the Hope Memorial Bridge and the beautiful sculptures. 4% said, hey, let's just call it the Cleveland Baseball Club, 16%. And the Lake Erie's was 7%. There was a couple other fun suggestions. How about the American, 7%? So I think Guardians takes the cake. I think that was the most fun. And then I did a little research, and I want you to take a look at this. Someone actually did some graphic renderings. And if you look at Guardians and the script logo looks a lot like Indians. So that could be the next name. So anyway, I want to thank everybody for their attention, their time. I'm sorry we could not be together. Hopefully this forum was effective. We had a lot of great speakers. Again, thanks for everything and your commitment to us and commitment to the food bank and cancer research with Velasano. Thanks so much for your loyalty. I really appreciate and love all of you. So please stay safe. We look forward to, call us anytime. We're going through our regular review schedule. If we don't get to you, please get to us. We look forward to it. We're ready for anything. So thank you very much. It's time for questions and answers. So we've got a few. I still see that we have a lot. Thank you very much, everybody, for sticking with us. I think almost everybody stood with us. So I've got a couple questions here. Oh, Solveig and the kids wanted to have a shout out. So I love you, Solveig, Christina, James, and Sophia. There you go. There's your shout out. Thank you for tuning into Dad's boring lecture here. I had a question here from a very knowledgeable client. I recently looked at the lithium battery. It has significant run up the past year. Do you think this is sustainable, or is this a bubble as well? Good question. A lot of these trendy, sustainable things were bubblicious. So I would say add carefully to that, and if it corrects, which it may, that's the time to add. So I want to have a shout out to Avon Lake freshman class of Christina, Micah, and Kayla. Thank you very much. Hope you guys learned something, and I hope you go to college for finance or technology. So many wonderful things you could study. Any other questions at this time? If not, if you don't want to put it in the chat, just email us or call us. We're happy to answer your questions. Again, thank you so much for your attention. Thanks for everything. We look forward to seeing you soon. Thank you. And good night, everybody.